Hi traders, Ben McInerney here from SpotOnForex.com. Today we're talking about risk and specifically risking 1% of your account per trade. Look, although 1% is a great place to start, sometimes it's not that straightforward. So I feel the 1% rule doesn't really make sense. For example, what if you're a little overambitious with your initial deposit amount? Could you be risking too much? The 1% rule assumes too much. As we all know, trading Forex is 80% psychology and 20% technical ability. So keeping yourself in a sound frame of mind, even after sustaining a string of losses, will put you at a significant psychological advantage and allow you to carry on. So I've got a better idea. Why don't you find a dollar amount that you're comfortable losing? This is called the psychological amount. So how do we arrive at that? Step 1. We need to know the maximum potential for drawdown. In a game of chance, such as flipping a coin, there is a probability of getting up to 7 heads in a row before you flip to tails. So looking at trading, if you were to blindly enter a trade, either buy or sell, you could say there's a 50-50 chance of the price going up and down. Now add the human psyche in there and placement of stops and market drivers, and that can actually blow out to more like 10. So let's say, to be safe, there is a maximum potential of having a drawdown or a string of losses of 10 in a row. So that being the case, we need to find an amount that we are comfortable losing in the worst case scenario of getting a losing streak of say 7 or 10 trades in a row. So step 2. How much are you willing to lose? Let's say, for example, you got that string of 10 trades that were all losers. What would be your maximum drawdown amount that would allow you to carry on, that wouldn't really bother you? You could just brush it off and continue trading. Is it $1,000? Is it $5,000 or $10,000? This is deeply personal. It depends on the trader, your current disposable income, and all sorts of factors. So that's up to you to decide, but think of an amount that you are willing to lose. And step 3, divide that amount by 10. Let's have a look at a couple of examples. Example number 1. So this trader's current account balance is $23,500. So the current risk based on the 1% rule is $235. Now this person has stated that their maximum drawdown is $1,500. They don't want to lose any more than $1,500. So this is what they are comfortable in losing. So we get that amount, divide it by 10, so your psychological amount is $150. Now you can see here, even though you have a fairly large account size, you're only truly willing to risk $150 per trade because that's what you're comfortable losing. Example number 2. This trader's account balance is $10,000. They're currently risking $100. But they've stated their maximum drawdown amount, and the amount that they're comfortable losing is $2,500. So again, we divide that by 10. Their psychological amount is $250. Now trader 2 might actually have a bigger bankroll than trader number 1. It's just that they haven't put it all in their Forex account. So in this example, this trader can quite easily trade 2.5% of their trading account, where trader number 1 might have been a little overambitious with their initial deposit. So it is a good idea to possibly adjust your account balance to suit your psychological amount, so you are trading 1%. It does make things easier, especially when your account does start to grow and you need to slowly start edging up the amount you are risking per trade. But it is crucially important that you find an amount that suits you personally. Setting up for success. You really need to be unaffected by the amount you are losing, not only in drawdown periods but for each individual trade you take. You need to internalize the belief that there are a random distribution of wins and losses for any given set of variables that define an edge. That being a fact of trading, when those losses do come, you need to be able to deal with it in a correct manner and not jump off the deep end. Now, if this predetermined amount causes you to feel emotionally charged at any point during the trade or after the trade has been closed out for a loss, you could be setting yourself up for future losses without even knowing it, just because your view of the market has become warped with emotion. The opposite is also true for wins. If you are risking more than you should be and you get a string of wins of say 3 or 4 in a row, you might get a feel of joy, elation, and confidence and go straight back into the market making poorly planned trades just because you feel you can't do any wrong. So again, take the time to work out what you are comfortable in losing and possibly adjust your trading account size and risk based on that figure. Thanks for joining me for this lesson. We have a lot more free lessons at spotonforex.com in the resources section, so hope to see you there soon.